Today, Operation Jawbone, the Jackson Hole fallout. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and problem news with a distinctively Australian flavour. So now the question is, how will global investors react to the overriding message from the Central Bankers Lovin-in at Jackson Hole? Federal Reserve Chair Jerome Powell's stern message was that interest rates are going higher for longer in a painful fight against inflation, and be clear, he quashed thoughts that the trajectory of monetary tightening could be tempered anytime soon. Powell spelled out the need for sustained restrictive policy, comments that lifted the US 2-year Treasury yield towards 2022 highs and sent investors scurrying to the dollar as a shelter from volatility. Jerome Powell's promise of policy pain to contain inflation quashed hopes that the central bank would ride to the rescue of markets, as they've done so often in the past. The prevailing message from the symposium was that borrowing costs are going up from the US to Europe to Asia, and officials are combating some of the highest inflation in a generation, stoked by damage to supply chains for energy and components due to Russia's war in Ukraine and COVID curbs in China. Restoring price stability will likely require maintaining a restrictive policy stance for some time, Powell told the audience at the Fed's annual retreat. The historical record cautions strongly against prematurely loosening policy. So investors now see the Fed's policy rate peaking in March at around 3.8%, and they paired bets on a decline in 2023. The US yield curve between the 5- and 30-year maturities inverted for the second time this month, while the gap between the higher 2-year yield and the 10-year yield widened. The inversion suggests the bond market anticipates a recession is the necessary sacrifice to get price pressures back under control, although I do note already some bank economists are claiming that the bond market really hardly reacted, and they believe that Jerome Powell was mainly jawboning. I guess we'll see. The tough love message was driven home by European Central Bank board member Isabel Schnabel, who warned over the weekend that central banks must now act forcibly to combat inflation, even if that drags their economies into recession, and with further catalysts for volatility ahead, from the shutting of the key Nord Stream gas pipeline to Europe for maintenance, to a ramp-up of the Fed's balance sheet rundown, to crucial US labour data, caution is likely to remain high. Powell was really hawkish at Jackson Hole, said Manish Bhargava, a Straits Investment Holdings fund manager in Singapore. There'll be a lot of red on Monday in a fizzling summer rally as money exits emerging markets, he said. The main takeaways are taming inflation is job number one for the Fed, and the Fed's rate needs to get to a restrictive level of 3.5% to 4%, said Jason England, Global Bond Portfolio Manager at Janus Henderson Investors. So futures are now pricing in around a 60% chance the Fed will hike by 75 basis points in September, and will see rates peaking at 3.75 to 4%. Much might depend, though, on what the August payroll figures shows this Friday, when analysts are looking for a moderate rise of 285,000 following July's blockbuster 528,000 gain. 2-year US yields were up at 3.44%, far above the 10-year at 3.08%, and yields climbed across Europe with double-digit gains in Italy, Spain and Portugal, all of which benefited the safe haven US dollar as it climbed to 109.15. That's just a whisker from a 20-year high of 109.29 reached in July. The dollar scored a 5-week high on the yen at 138.21, with bulls looking to retest its July top of 139.38. The dollar is now up 10% this year, while the yen is 16% down, and that leaves it at the bottom of the G10. The hawkish message was not what Wall Street wanted to hear, and the S&P 500 futures was down a further 1.1%, having shed almost 3.4% on Friday, and Nasdaq futures lost 1.5% with tech stocks pressured by the outlook for slower economic growth. The euro is struggling at 0.9937, not far from last week's two-decade trough of 0.99005, while sterling slipped to a one-month low of 1.1686, and the Aussie was at 68.67 this morning. And on Monday, the Aussie market opened about 2% lower. Other themes from the symposium focused on productivity. Just about every conversation I've had since I got to Jackson Hole yesterday has noted that the GDI data for the second quarter, which came out yesterday, was much stronger again than the GDP data. John Fernald, an economist at the San Francisco Fed, who co-wrote the productivity paper, said during his presentation last Friday, those conversations underscored the uncertainty among policymakers and economists about not only where the economy is headed, but where it is right now. Central bankers may be inclined to see weaker productivity as raising inflation risks, which in turn might eventually push them to raise rates even higher. The key variable for so much is productivity. That determines the constraints on growth. It determines how much slack there is in the economy, which determines what you need to do for monetary policy, said Kristen Forbes, a professor at Massachusetts Institute of Technology. And we just don't know where it's going to settle after COVID. And then there are central bank balance sheets. A paper on central bank balance sheets presented on Saturday sparked a wave of comment from central bankers in the audience, including Bank of England Governor Andrew Bailey. The world's biggest central banks have begun winding down the balance sheets, which they scaled up during the pandemic to relieve pressure on banks and keep long-term interest rates low. The asset purchases created reserves in the banking system, and the unwinds are now extinguishing those same reserves. The question is how much unwinding the central banks will be able to do before they run into potential financial stability issues, and how to adjust if they do accidentally go too far. There is a very challenging question in a tightening monetary policy world if we need to intervene for financial stability reasons, because doing central bank asset purchases in a world where you are tightening policy is a very difficult message to get across to the outside world, Bailey said. And the third question was whether those higher rates are temporary or more persistent. While the overwhelming consensus among conference attendees was that central banks need to respond aggressively to price pressures as many countries face the highest inflation rates in several decades, there was less argument about whether long-term trends that prevailed prior to the pandemic would eventually reassert themselves. That sentiment was reflected in Friday's panel discussion. Jason Furman, an economics professor at Harvard University, argued that central banks should consider eventually raising their inflation targets, which most in developed countries have set around 2%, to avoid imposing unnecessary pain on the economies over which they preside. So expect to hear much more on the trade-off between higher rates of inflation and higher unemployment, and whether the 2 or 3% targeting, which has become a cornerstone of central bank doctrine, is actually relevant and appropriate. But meanwhile, other than commodities and perhaps the US dollar, there is actually nowhere to hide. And Bitcoin came out in sympathy to 19,653, down a further 1.69%. So it boils down to this. To what extent will the markets look through this and simply see this as jawboning and try and convince the Fed and other central banks not to continue to raise rates and to intervene in the markets like they did a few years ago? Or is it really different this time? In other words, do they really mean it? Or was it just jawboning the markets? Well, we'll find out in the weeks and months ahead. But my own feeling is that this time it's different. Rates are going higher. Markets are going to crash. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.